Welcome to Agency Acquisitions and Exits. I'm your host, Peter Lang. Today, we welcome my friend Grant Hensel, the founder and managing partner of Entrepreneurial Capital, a fund focused on backing self-funded searchers, acquiring profitable, enduring small businesses. Before launching the fund, Grant started 10 companies. He built an agency called Nonprofit Megaphone into a 60-person agency, and he and his wife, Julia, acquired Lexigate, their past episode on the podcast, a law firm SEO agency, now that Julia runs and operates. His journey is unusual because he has lived all sides of the equation, starting companies, buying companies, operating agencies, backing searchers, and now raising capital around the self-funded search model. From founder to fund manager, join me for Grant Hensel on backing self-funded searchers via a fund. Grant, I appreciate you taking the time to share your insights and experience from creating a fund from scratch, your very first.
It was a joy. Excited to talk about it.
For those of you who have not heard of Grant Hensel, shame on you, but we've done an episode in the past, and his wife Julia joined us on their acquisition journey. But we didn't really cover this other project that Grant has. And so, Grant, you're the managing partner and founder of Entrepreneurial Capital. What is Entrepreneurial Capital?
We are an investment fund that invests in people buying and then personally running small businesses under what we would describe and the world describes as the entrepreneurship through acquisition or self-funded search model. And these are typically people buying small, what we would call boring, enduringly profitable businesses and intending to run them for at least the medium term and potentially the long term.
You have a 60 per plus person digital marketing agency servicing nonprofits. What the heck did cause you to start a fund?
It was an evolution. One of the things that we found as we were growing the digital marketing agency was, and I found that the less operationally involved I was, the better the business did. And so that led to us having a really fantastic COO who started basically running all the operations. And then eventually she became the CEO. And it turned out that I had meaningful spare cycles of capacity that would not be productively deployed into the business. I would cause problems actively if I put all of my energy into the business. And we also wanted to develop M&A capacities. We considered inorganic growth as a growth lever for Nonprofit Megaphone. And so part of the thought process is Grant has a ton of time available. Also, it would be helpful for Grant to develop these skills. What if Grant started developing these skills? And that led to what we talked about on the last episode of my wife and I buying a business that she now runs. So I did the search, we found the business, we bought it, she now runs it. We've done one add-on acquisition into that. And then I started investing just personally into other people's entrepreneurship through acquisition, self-funded search deals, and ultimately had a couple mentors who said, these are really interesting deals that you're finding. You should do a fund and do this on a more professional scale.
Do you attribute the inbound investment opportunities to the PR and response to you and Julia buying Lexigate?
It significantly helped. So the market for investment capital and people buying small businesses is wildly fragmented. There's a relatively small number of people who focus on that. And so yes, us having done it and having walked in the shoes of a searcher who's acquiring a business, I think has been helpful for us, not only in selection, but also in marketing and sort of people thinking that would be helpful to have supporting them, both in terms of capital, but also in terms of perspective.
From a corporate finance perspective, you don't have the traditional investment banking, Wall Street time. You ran an agency servicing nonprofits. Grant, where did your curiosity, comfort, I'm putting words in your mouth here, but come from? Hey, I've just done a little bit of the M&A thing, and now I'm going to do more M&A for more people, and really spot opportunities and support searchers. Like, how did you make that bridge?
I went to, interestingly, from another mentor's recommendation, I went to Booth, University of Chicago Booth, for their MBA program. And Booth has a very big entrepreneurship through acquisition focus and community and class, and does a conference, which I was part of helped put on while I was there. And so I had a number of friends and people I knew who were in that world. And then we did it. And I'm a person who derives confidence from having done something myself, for better or for worse. And then once we've done it both ourselves of actually finding and buying and running, and then actually investing in other people's acquisitions with personal capital, and those seeming to be going well and attractive, it then gave me the confidence and the willingness to do it with other people's money. I've never raised or borrowed a dollar of money from anyone ever for anything other than entrepreneurial capital. And so that was a personal comfort process. Like I was
Yeah,
very opposed to the idea originally.
it's outside your comfort zone. So it sounds to me like the journey was, I know this thing exists. I got mentors who think I would be good at it, who support me in it. I've done these incremental investments. How do I continue to advance myself professionally, create value, and help the community that I learned and am excited about, and create positive returns so I have compound reputation and credibility as I continue to extend for the next decade plus? That's a great journey, great in retrospect. Did it feel that organized and that planned while you were doing it?
I think that once the decision was made to do it, to launch Entrepreneurial Capital, I do think it was funny to think back on how my past experiences actually, in some ways, did beautifully line up for this in a way that was better than like investment banking or even having worked for a larger private equity firm, because the lower middle market where we play is just wildly different from anything that anyone in investment bank would be dealing with. And it's just an operations game. It's a knife fight. It's a small business operational knife fight. And I do feel at home to the extent you can in small business operational knife fights, because that's what I've been doing for the last 10 years.
Yeah. You get to support founders who are in the same seat you were, and there's a level of confidence, I believe, in supporting those types of founders. We talked about it with Julia as well. Both of you have a compound professional career that seems to be timed really well with the projects in front of you, which has got to be fulfilling. Do you get a lot of fulfillment from the work outside of course, the challenge and the investment side?
I love it. I love it. I've always enjoyed entrepreneurship 10 out of 10. Like I couldn't imagine enjoying something more than that. But I found that I enjoy the investing side 11 out of 10,
Ooh,
interestingly, like more than I thought was possible. So that's been a joy.
unpack that. Like, what about it? Because those of us who are entrepreneurs who are listening to this go, what? There's something better than entrepreneurship?
I think it's highly personality dependent. For me, there is nothing better than working with an extremely capable and motivated and determined small group of people who are trying to run through walls, and you're just trying to be helpful to them. I love that. There's a test or an assessment called Strengths Finder, now called Clifton Strengths, that has a list of 34 attributes or strengths of things you can be good at. Two of them that are related to other people and your interactions with them are developer, which is like a teacher helping someone go from not that good at something to good at something. And I am horrible at that, unfortunately. And then there's another thing called maximizer, which is helping great people become exceptional. And I'm decent at that. And I love that. And that's my entire job it's my entire job post investment in entrepreneurs that we invest in. And it's the same thing like with supporting a CEO or leadership team. Now just doing that across multiple organizations, which has been a ton of fun.
Do you know your top 5 themes off the top of your head?
Yeah. Yeah. So I've done it I've done the test like 4 times. And so there's a little bit of non overlap, but a couple of them are achiever, competition, futuristic, learner, focus, strategic, maximizer. And I've gotten input a couple times as well.
Yeah, and it's interesting when you do these assessments after different career points, whether it be buying a business, selling a business, starting one, you actually shift slightly. It's interesting to see it evolve over time. Curious, do you use it in your evaluation of potential searchers?
No, I think it's a better self-knowledge tool than a assessment or like hiring tool effectively. Other things that we're evaluating with respect to that, because that is the key. Like earlier today, we had an interesting meeting with a group that we're going to test out who has done very intensive screening, psychometric assessments, structured interviews, and so forth for like senior government positions and like Navy SEAL candidates and senior corporate leaders. So we have a decent process, but we're constantly trying to make that better. Because to me, that is the secret sauce.
Yeah.
Is you can think through, is this business reasonable? Is this industry reasonable? The more of the black boxes, is this person going to run through walls to be successful? Are they trustworthy? And are they capable of learning and growing? And do they have the IQ and the EQ needed in terms of the raw horsepower to make it happen? And that is just really hard. And because if you find the right person, yeah, it's incredible. I invested in a searcher. This is personally before the fund, but he seemed like an awesome guy, seemed great. And he is an absolute killer in the best way possible. He bought a small HVAC business in Florida, and we're recording this in May of 2026. He's on track to like so much more than double revenue year over year in his first year. It's unbelievable with no incremental marketing spend, just by doing everything better and just by being incredibly determined. So yeah. And I didn't know that.
Yep.
I knew he was good. He seemed good. It felt like he was good, but the man is world class. And it would be nice if we could more reliably know that in advance.
If you could unpack his behavioral and character attributes into some predictive assessment that you would not share publicly, as it would be a competitive moat for Entrepreneurial Capital. But unpack this, because it sounds great. But you decided, when was this? June? When did you close or announce the initial close? June 25?
Yeah, the initial close was in June of 2025, I think.
Okay, so work backwards from there. You're like, I think I'm prepared to professionalize my responsibilities as an investor to these searchers. You talk with Julia about it. What's the next step? What'd you take?
Yeah, so this would have been November maybe of 2024. And so the first step was we made a pitch deck, because that's of course what you do. And we were on vacation in Thailand. And so we're at the airport building a pitch deck. Julia was ex-BCG, so she's making it actually good and look nice. And then the next step after that was you follow the classic rule of ask for money when you want advice and ask for advice when you want money. So I started asking mentors for advice, and in a deeply impactful way, a number of them said, deck looks great. And also, I would like to support you in this, which was wonderful. Then started sharing more broadly. Ultimately announced it on LinkedIn, which ended up being enormously helpful. And yeah,
so
we can get
when did
into
you, if you're open to it, when did you engage Michael over at Teal Law?
So Michael, who did our fund formation documents, I believe we engaged in January of 2025.
Great. So this is important context, right? There's if you've never started a fund before, there's a value chain. There's people who you can hire, you work with to do these things. Maybe unpack that bit for the listener.
Absolutely. Yeah. So when I had a mentor who said, Grant, these deals are awesome, you should do a fund, I said, I have no idea how to do that. And he said, you'll figure it out. You're an entrepreneur. Get out there. And I found someone who had started a fund similar to ours, and I asked him how he did the legal and formation doc side of things. He referred me to Michael at the Investments Lawyers. Michael is amazing, highly recommended. The dude is amazing. His whole group is amazing. This is all they do, fund formation documents. So perfect. And the process is we had a kickoff call, and then we basically talked through what are the fundamental terms that we are offering to investors in terms of structure and like the economic and governance scenario. And that produced effectively a term sheet, which is still quite in depth, that basically explained all those things. And Michael's process is, okay, now you have a term sheet. So if people ask, you can answer the questions. We don't need to do all the documents right this second. Go out there and fundraise. And then when that's looking good, then tell us and we will finalize the documents, and then you can have everyone start signing them. So we did the term sheet very quick and then started the fundraising process.
Yeah, so that's important. Most of these firms who will do the documentation range from 30 to 50K, maybe 60, 70K as an initial investment. Depending on the size of the fund, how base it is, how similar to things that they've done before, or something that's bespoke. And so they're great resources. Their firm does great content marketing. I was actually surprised. I was like, hey, a firm that's actually keeping up with it. So they do educational resources around fund formations, around what's happening in the industry, similar to you, like create a great artifact for others and breadcrumbs so they can go on a similar journey.
Yeah.
Anything else that you learned from that process? Did you interview any other law firms before moving forward with them?
Nope. Because the pricing was reasonable. They came recommended, and they're just clearly really
They got
nice,
it. Yeah.
thoughtful guys. They've been so helpful because, little things come up. We would have someone who, and this is even after the close, someone says, "Hey, I'd like to increase my allocation a little bit." And so that requires a allocation increase agreement, which they just whipped up for us in no time at all and didn't charge us for it because they're just the nicest people. So yeah, we're huge fans.
Okay, so they said we've organized the structure. So you didn't have any entity formation or the long form documents yet. You just got to the term sheet and started fundraising.
Absolutely.
What did you learn about what you could do publicly in your fundraising efforts?
So the key distinction and the key decision that you'll make, which also relates to the legal docs, is what type of fund are you raising? And we were raising under what's called Reg D C. There's also Reg D 506B, where you're not allowed to talk publicly. But in Reg D 506C, you can talk publicly. And the restriction, though, is you have to say in all of your public discussions, this is only open to accredited investors. And you have to validate people's accredited investor status. You cannot only rely on a self-representation. Although the SEC actually has later done a no action letter where they said, if your commitment is more than $200,000 as an individual from an LP coming in, or more than $1 million as an entity, it would appear that you're fine and that you don't have to do more than a self-attestation, because accredited investor, the threshold is you have to have at least $200,000 of personal income or $300,000 together with a spouse for each of the last 2 years, a reasonable expectation of that continuing, or $1 million of net worth excluding your primary residence. And so the SEC's theory is like, if someone's stroking a check for 200 grand, they probably either make 200 grand a year or have a net worth of above $1 million. So it's probably fine. So anyway, we chose that path because we wanted to be able to talk about it publicly.
Well, did you have under the term sheet kind of an expectation of how large you'd like the fund to be and your approach for generating returns for it?
Yes. So in our presentation deck, and obviously there's disclaimers all over everything. You can't promise anything at all. It's illegal. But we outlined our philosophy. And originally the concept was that we wanted to raise on the order of $5 million, which ended up being bumped up to 10. And then we ultimately accepted a little bit above 12, almost 13. But the deck basically goes through what asset class are we investing in, why, which for us is small businesses acquired by self-funded searchers. Why do we find it attractive? Variety of reasons why. How will we underwrite deals? And then what is to me, the most intellectually honest way to give a sense of target projections, which are not a promise, is to say, this is how we're going to do our underwriting process. And so we basically said, we intend to invest in deals where if they grow revenue by 5% a year, margins do not expand and the multiple does not expand, and then they're eventually exited 7 to 10 years later, does that produce a 30% IRR, internal rate of return, to us as investors? If yes, then we view that deal positively. And if no, then we view that deal as unattractive. And so our commitment to you is we are going to try and find and invest in deals where that is true. And then if those assumptions are met, obviously everyone will be very happy. We hope to exceed that, but the world is unpredictable and you never know. But that's our approach.
Yes. And there's a chance you may lose your investment entirely.
Correct. Yes. Returns are never guaranteed. Yeah. All the disclaimers.
So you had a summary of terms. You already had the deck. Did you already identify all the service partners? So the administrator, all the bits that are supportive of the fund?
We did. Again, the investment lawyers were very helpful with that because we just asked them for recommendations. And so we interviewed a number of fund administration partners, which is basically a fancy word for accounting for the fund, and a little bit of other admin work, but honestly, it's just accounting mostly. And sort of doing statement of capital accounts at the end of the year. And identified insurance providers, identified technology providers. There's tools that you can use to make it much easier for your investors, your LPs or limited partners, to send money to you for capital calls and to receive money as distributions. Most funds are very antiquated and we wanted to provide a better investor experience. So yeah, they were enormously helpful in making those recommendations of options.
And then when it came to forming the entity, you had invested in businesses before. You had started companies. What did you learn about the nuances of kind of the operating agreement and the understanding of running a fund versus like an LLC, a small business?
So some things are very similar, but other things are different. We are actually three entities. We are Entrepreneurial Capital LLC, which is the management company, which is, who pays our team and so forth. And then there are two entities for each fund. We only have one fund, so we have two entities for that. Entrepreneurial Capital Fund 1 LP, a limited partnership, which is what is the vehicle that all investors, including myself, pool their money into. And then that vehicle makes the investments. That vehicle pays a management fee of 2% of assets to the management company, which is how the management company funds its operations. And then it provides a carried interest, profits interest effectively, to the third entity, which is Entrepreneurial Capital Fund 1 GP, or general partner, which is just an LLC owned by me. And yeah, we can talk about how the fund economics work, but there are three things. The governance for Entrepreneurial Capital LLC, the management company, is extremely easy. It's a single member LLC owned by me. Same for the GP entity. The LP entity is where all of the complexity comes. So we have a limited partnership agreement, the LPA, which governs the relationship between all of the limited partners and the management company and the general partner. And that is north of 100 pages long because it's quite involved. But
Yeah.
fortunately, there are standards. And so it's basically like 200 pages to say this is a standard fund and all the standard rules apply.
Yeah, you're not reinventing the wheel here. So your LPA, you have subscription documents with that.
Correct.
You have your
Yeah.
management agreement for your management company, and then the PPM, private placement memorandum.
Yep. Yeah. And just to explain the subscription documents, because that's a new concept, is the document that investors sign when they are providing a capital commitment and making their initial capital call to you. And in the subscription agreement, they basically agree to the terms of the limited partnership agreement. But there are
Yep.
also
Yep.
other sort of representations and warranties where they're saying, this money is not illicit and all kinds of other things.
If you're listening to this and you're like, wow, that's a lot of information Grant knows. Remember, he didn't know how to start a fund when he started. These are all things that the law firm and the service providers who are supportive of funds teach you as you go through building it. And then you get the reps because you're explaining it to people potentially who are able to invest, accredited investors, but may not understand a fund. It might be their first fund that they invest into. So Grant, you've had a few reps, haven't you?
I've had a few reps, yes. I've probably explained these terms or similar things dozens, if not hundreds of times. So you definitely get more comfortable with it over time.
Okay, so you've drafted the principal fund documents and you've been reaching out to investors. What did you learn about this investor outreach, investor acquisitions effort?
I learned that almost 100%, if not 100%, of the people who ultimately invested in us came through some form of warm-ish channel. So the vast majority were people that I would describe as loose ties, of people that I had met at some point, and maybe we didn't stay in very close touch, but they knew who I was and had a sense. Maybe we went to college together. Maybe we were in entrepreneurs organization together, or maybe they were friends of one of those people. That was by far the largest group of people. And that group was activated by posting on LinkedIn and sharing, hey, we're doing this thing. This is how it works. And then ultimately doing a webinar, which was also promoted on LinkedIn just through organic. I think I posted about it 4 times. We
Yeah.
had a little over 150 people join the webinar, and millions of dollars ended up being raised from those people ultimately who said, okay, I like this. Let's do it.
Yeah. In the agency ecosystem, there is investor acquisitions as a category of agencies. They actually help host these webinars. And the call to action is invest now. And it's an actual campaign strategy to get in front of investors. Maybe unpack that a little bit more.
Yes. So we tried some of those with zero success. I think one of them produced like one investor total, who's actually a wonderful person. Like it was not financially worth it, but it was worth it just to meet him. There was, yeah, we tried, I think two groups. And then I tried some other paid channels like advertising in newsletters that were sort of private equity related and so forth. And all of that was just a clean zero in terms of actual results, interestingly. The things that did work were, posting on LinkedIn and activating the warm network, and podcasts, actually being on good podcasts and talking about in detail that produced people, because it is ultimately a trust thing. And people need
Right.
to trust two things. They need to trust you and they need to trust the thing that you're doing. And that just requires probably hearing you talk for like an hour. And
Yeah.
so podcasts are a good way to do that. And cold email is a horrible way to do that, at least in our experience.
How was the conversions? How many conversations did you end up having, and what that lead to in, investments?
The conversion rate was strangely good, probably because there was some degree of warmth in the relationships already. But I think I had on the order of 160 one-on-one conversations with potential investors
Over what period of time?
over. Um, we started in February of 2025, and then we had raised most of the money by like June, something like that. And then at that point I stopped proactively fundraising, but people would just sort of trickle in. We had a link on the website where you could book a time if you were a prospective investor. And so those sort of kept trickling in for a while. And then we officially did a final close and said no more capital in October, I think, of 2025, if memory serves. But the vast majority was between February and June.
Is that a timeline that aligned with your expectations?
Everyone I talked to said fundraising is horrible and it'll take 18 months and it'll be the most painful thing you ever do. And so each of those ended up being incorrect by the grace of God. It was much shorter than expected. It was much more fun than expected. Like I really enjoyed including the no's. It was just wonderful people who were very interesting to talk to, had interesting thoughts. So I was surprised. I loved the fundraising process. I'm sad that it's over, to be honest, but there will always be more in the future. So I don't need to be that sad.
Mm. We're foreshadowing a bit, but that how many total investors ultimately came in?
Roughly 80.
Okay. Were you surprised at the distribution of check size?
One of the things that the investment lawyers told us is whatever you set your minimum commitment to be, that's going to be what the vast majority of people do. And so our minimum commitment was $100,000. And I think our average investment ended up being on the order of 150, something like that. So the vast majority of people right at the minimum or just above the minimum. And the largest check was $1 million. From myself was $1 million. And then from another group was $1 million, another individual. And then everything else was smaller than that. So we had no institutional investors, just all individuals.
What level of investor relations or communication expectations were set for you?
It was interesting. I had some conversations with mentors about what would be appropriate. Originally, I was thinking, oh, maybe we do monthly emails. And they're like, that's insane. Definitely do not do that. So we do quarterly. We do quarterly emails on the first day of every quarter. And then I also share in the middle of the quarter, if we have a deal that it's looking like we're going to give a soft commitment to, I share about that transaction with the LP community. And one, I'm curious if people have input on that. And a lot of times the LP community has provided very helpful input. And two, I just want people to be informed and transparent, and I want them to have a sort of front row seat into how things are developing. And it's been interesting because to me that felt like very, very essential communication, but certainly not overwhelming. And the feedback has been wonderful. People are like, thanks for the communication. This is so helpful, which I'm in a decent amount of private market investments myself. So I get it now. It's like doing reliable quarterly or on any schedule, just like reliably hitting a performance or a update schedule goes a
Yeah.
long way. It is the best thing you can possibly do to build credibility over time. And I get it. It's like if you can't even give updates, like why would I trust you for anything else?
Yeah, especially in private markets where, so much is in a black box versus capital markets, public markets. Um, you learned something about how you could communicate to the next investor prospect how much progress you were making. This is a very interesting thing because no one likes to be the first money in, Grant, or the newest money in relative to the fund. So what did you learn about what you could say about people's involvement and interest?
So there's a whole language that has been invented to facilitate this process, which is very funny. But to give you the inside scoop, there are multiple ways to report your progress. Way number one is soft circled, and that is the broadest of the categories. Soft circled means someone is considering an investment of X. They have soft circled it and now they are considering it. They're doing their diligence. They're thinking about it. And that's really all diligence is for like a vehicle of this size. We're not doing like in-depth analysis. We're thinking about it. And so at the beginning, if someone's raising a fund, you can share your soft circled number because that is the number of people that are considering it at the amounts that they are considering. And that is
Give it a little
basically,
bit, give it a little more color.
it's meaningless.
Yes.
It's meaningless. If Peter says, like, this is interesting, like, let me get back to you. So then I would say, like, just to give me a sense, like, what are you considering? And Peter says, like, well, if we did it, would be like 250. So that goes into a spreadsheet that says Peter Lang, soft circled 250, which is not, I mean, that's what the word means. It means I have
Yeah.
people that are considering it with a dollar amount attached to the consideration. A step up from that is committed. So where Peter says, I am in for 250.
But bridge that because you're also actively doing this before you have definitive documents.
Yeah, correct.
So even if I was in, I couldn't sign something today.
Correct, exactly. And that brings us to the next tier, which is still not signing documents, which is committed. Peter has said,
Yep.
I'm in, mark me down for 250. And then you have like signed, like truly you've closed, where Peter has signed documents saying that there's 250. And then a step after that, and fortunately there's basically no drop off between that step and doing the initial capital call, but there'll be like a tiny little drop off. But yes, based on where you are in the process, if you're at the beginning of the fundraise, you're probably sharing soft circle numbers because that's going to be the best by far. And as you get to the end, you're sharing, look, we wanted to raise $10 million. We've now raised 12.7. We can let you in, but like we just got to call it at the end of this week. Like we're not accepting any more capital. So just do whatever you want.
Okay. So you had that in a more compressed time than you had originally had been set as an expectation. You were enjoying it much more than anyone else advertised. And the fund expanded. Explain the rationale.
As we were going through the process, after we did the initial close, which I think actually might have been in May, but it was in May or June, sometime in there, we continued fundraising, but we also started more actively looking for deals and doing deal sourcing. And as the year continued, that deal sourcing momentum continued to gain velocity. So once we got past $10 million, our initial target, we were seeing enough deal flow that it felt very reasonable that we would be able to deploy a little bit more capital. And that's the question that you have to ask yourself is, am I going to raise too much capital such that I can't deploy it in an appropriate timeline, which for us was a 2 to 3 year investment period, and at an appropriate quality? And so it became clear that, okay, maybe originally we thought if you take a 3 year investment period, that we'd be deploying roughly $3.3 million a year for a total of 10 over 3 years. And then the question was, do we have enough deal flow to support $4 million a year of of investments? And the answer was, we absolutely do. And so it's okay for us to accept a little bit more. At some point, you just have to call it and stop raising money because there is a little bit of a distraction that it causes. It's just another thing. You have to take calls with people. And at some point, you just have to say, we're not doing those calls anymore. We have to just focus 100% on deployment.
What's interesting is the correlation between the investment check size and the check size you're deploying to support searchers. It's actually quite similar.
So our ideal check size, and the ranges have bumped up a little bit. Originally, we said our minimum check size is 50. Now we'd say on the website, it's a minimum of 300, but our desired check size minimum is probably 500 as a minimum. And our sweet spot is probably $1 million to 1.2 million. We would prefer to make a smaller number of really focused investments that we have a ton of confidence in, as opposed to overly trying to spread and diversify.
Was that something you matured into from perspective, or is that something you were, had in your original thesis?
The original thesis said 13 to 18 total investments was what was envisioned. The original thesis also assumed slightly smaller fund, and so the check size sort of naturally bumped up. But it also came from speaking with, we have a couple of LPs who are enormously helpful as just advisors that have been very plugged in since the beginning. And a number of them shared from their own deployment experience, their own investing experience, that it is often much better from both a focus and just streamlining perspective, but also from a returns perspective to have a slightly smaller number of slightly bigger bets that you can just pay more attention to. It's nice to spread your time over fewer active deals once the investments have been made to be supportive to those companies.
Especially at the size of the fund.
Exactly. Yeah.
Kind of shed some light on the investment criteria? So what size EBITDA typically are these searchers bringing to the table in these deals?
The minimum we'd say is 750, and we would say of either SDE or EBITDA. So really, it's minimum of 750 SDE because SDE is always going to be uh, the higher number than EBITDA. And we do not want to pay more than a 5x multiple. And we want businesses with low customer concentration that have capital efficient operations that are resilient in a recessionary environment and that are likely to be enduring and resilient to dramatic disruption.
Who doesn't, Grant?
Oh,
Goodness.
exactly. No, it's the most boring criteria ever. It's just
It's
like, yeah, we want
everyone's criteria
enduring
unless you're in venture.
Correct.
So what did you learn about that sector as you've been seeing more and more deal flow, like that criteria?
Deal flow is the key. Deal flow is the key because it's what everyone wants. And it is, though that is what we're just describing is an attractive business. And so that, and getting it for a reasonable multiple is difficult. And so it is all about deal flow, both for us and for the searchers. We review roughly one deal per business day. And so that is hundreds a year. And we need to find, 4 a year, 5. That we invest in and maybe less. And so it is all a deal flow game, which is why I, spend so much time posting stuff on LinkedIn, and we have a newsletter, and we do a lot of conferences and go to put on webinars and do things like that because we just want to be known to as many searchers as humanly possible as a capital source.
So you have two forms of sourcing. You have to find searchers, or searchers have to find you, kind of a combination. And then it sounds like you're also putting yourself out there for sellers who you can match with a searcher.
Yes. And it's far more often the former than the latter, but occasionally. And we've had a couple of things where we've been able to match sellers with a searcher in our network. Not yet one that is also in our investment criteria. We have one actually that we're working on now that might be the first. That would be kind of fun. But yes, we want to be a resource, and we have all the incentive in the world to be a resource to sellers, to searchers, to anyone, because we just want good deals to happen, and then we would like to invest in them.
Private equity firms would also invest in professionals, train them, bring them into their circle, give them, temporary residence over something in the portfolio, and then have them go out and search so they can expand on their relationship over time. You're getting new people in. So we've talked about your investment criteria. What's the searcher criteria other than, willing to run through walls and durability? When you meet them, how many calls does it take? What's the process look like?
We're looking for, in the immortal words of Patrick Lencioni, who's written a number of great books, humble, hungry, and smart people who, as you said, can run through walls and are reliable and are quick to surface bad news and try and solve it as opposed to hiding it. I have the IQ and the EQ needed to just be a all-around business athlete that is going to be dropped into a situation where a bunch of stuff is going to be on fire and a bunch of stuff is going to be really promising, and they're just going to have to figure it out. We always, start with a call. Our screening process is we look at a deal and the materials for a deal to see, does this seem like an initial fit? If it does, the team then does a call with the searcher to sort of do an initial screen on them. If that goes well, then we talk about it as a broader team. And if it seems like it's a deal worth continuing with, then I do a call with the searcher alongside the team. And then we do more in-depth diligence. And if things are looking good, I meet the searcher in person, or we find a way to meet the searcher in person, ideally at the business's location. And what we really like to see where possible, it's not always possible, but what we like to see is the searcher and the seller interacting live in the business's place of business, just to get a sense of the dynamic and what's actually going on. And then we do all kinds of checks. We do a variety of reference checks. We do background checks, credit checks, all kinds of basically validation processes. We try and activate our network from our ADLPs to see if we have any third or like second degree connections that go from someone we know and trust to this person. Because that's the most important part. Is not possible to invest in a good deal that has a bad searcher. It will blow up in your face.
What have you learned about the business of funds?
Business of funds is a wonderful job if you have other sources of income. unless you are doing a massive fund.
Let's double tap that one more time for you folks who've heard that starting a fund is a lucrative profession.
Nothing could be further from the truth.
Let's unpack that for the listener.
Yeah. So imagine you've raised a $10 million fund, just to make the math easy. And you would
Twice
think,
the size you thought you would raise
oh,
when
absolutely.
you started. Yeah.
Absolutely. Yeah. And we're like the second largest fund that exists. Maybe they're now, maybe the third. But it- it- in what we're specifically doing, like we are by far on the large end. And there are two forms of income that come from a fund. There's a management fee and then there's carry. Carry is a profits interest, typically 20%, that happens after you've returned your invested capital to your LPs. So if Peter gives me $1 million, I need to give Peter back $1 million plus achieve what's called a hurdle rate, which is normally 8%. And then once that happens, then I start participating in carry. And
Yep.
it will simplify it, but it's basically 20% of incremental distributions after that go to me, and 80% go to Peter if he's the LP, in this case, the limited partner. Your current income is from the management fee. And so typically 2% is the management fee. So 2% of 10 million is $200,000, $200,000 a year. You will have expenses. You will have insurance. You will have fund admin. You will have legal costs. You will have a team. We have a team. And so I almost break even on the management fee while paying myself $0. So it is
Sounds like a wonderful vocation.
Exactly. So I will say that some of the social media hype around create a fund, it'll be awesome, is really good as long as you don't have need for cash flow in the next 5 to 7 years. Then it's wonderful. But it is not a direct cash generation mechanism by any stretch of the imagination. And there's all kinds of games. I will say there's all kinds of games that people can play in fund land where
to extract value at incremental points based on transactions and fees.
Exactly.
And, yeah.
Which we decided we're not doing any of those. And we will have no fund expenses. We will have no expenses other than the initial legal formation that we charge against the fund, which is very investor friendly, but cuts off a potentially lucrative stream of fun little fees and things that you can charge against the fund, because just we felt like that is not the right way to do it. So
yeah,
here we are.
There's a lot of people out there making promises they can't back. So you're in an interesting position. You've gotten to a certain size. You're deploying capital. How long do you think it's going to take for you to get all of the funds allocated and across how many businesses?
We'll see. It comes in ebbs and flows. And so if you do your run rate, it can make you think we're going to be done within a year, or it's going to take the full 3-year investment period. I don't know. I feel like we're a little bit ahead of pace in terms of the deal flow we're seeing and the investments we've made already, but we'll find out. My guess is that the 2 to 3 year total investment period will end up being right. It sort of depends on when you count. Do you count that starting at the initial close? Do you count that starting at the final close? I don't know. But yeah, I think we'll probably be in that range. And my suspicion is that we probably will be on the order of, if I had to put a number, I would say 15 total investments, which is in the middle of our 13 to 18 original estimate. That would be my rough guess. Maybe 16.
So you essentially became a volunteer with some upside for the next few years.
Correct.
Why did you do it, Grant? Because you could have just set the bar slightly higher and built a little bit more incentive. You're doing all of this for what reason? It's important to highlight.
Yeah, I love it. I think this is really enjoyable. I really like the learning. I think it's fun to try and make money for people that I like. Like I genuinely like all of our LPs. I'm also tied for largest LP, so I like making money myself. And I enjoy supporting searchers. I think that small business ownership is really important. And I just genuinely like this thing. And I'd like to do it for a long time. And so to me, the only purpose of Fund One is to demonstrate that I can be a trustworthy fund manager and steward of other people's capital. And so the ways to do that are not being aggressive on the fees and not worrying about trying to make money in the short term and being the largest LP and just doing things that make people have confidence that I am a worthy steward of their hard-earned capital in the future and when we do future funds.
And when you anticipate doing that future fund, what size do you foresee?
It depends on, in my perfect world, it would be somewhere between like $25 and $50 million. It will depend exclusively on what level of deal flow do we have confidence in being able to deploy against, because I'm not willing to compromise the returns to over raise. The whole, like, being an investment manager is 100% a reputation game. You have your reputation and nothing else. And so you just gotta
Yep.
you gotta protect that.
What has been some of your critiques of the experience, whether it be from searchers, whether it be from deals on the marketplace, the sources of those deals? What are some of the things that you examine and go, well, that could be improved, or you might have different expectations, or you might want to help them in different ways?
We found that collaborating with other investors has been enormously impactful. Everyone's doing the same diligence, so you may as well gut check each other and swap notes. We found that to be enormously helpful. My biggest piece of advice for searchers is just to lead with the problems. Like, don't try and hide the problems in a deal, either pre-close or post-close. Bring them up and ask for advice and brainstorm and try and solve them, because that is the skill that you will need in all forms of getting a deal closed is problem solving, and all forms of running a business is problem solving. And the other thing you need is to build trust. And by leading with problems and just being like, all right, this is warts and all, like, here are the warts. Let's talk about the warts. That builds trust faster than anything else.
You've gone from founder to fund manager. Do you feel like you're in business school again? Do you feel like you're seeing things with more, you're learning more?
I do. And I love that. I love learning and being forced to try and identify commonalities between industries or between searchers and extract principles that are helpful for our future investing. And I love that. I think that that is one of the reasons I'm willing to do this effectively for free for the short term, is that I just find the learning deeply intrinsically valuable.
Yeah, never mind the fact that you could have probably deployed your personal capital into assets that generate more free cash flow, given your ability to do M&A.
Yes, which has been your critique from the beginning, and it is a good one. But yes.
But but at the end of the day, you're learning to expand your capital pool, which it was really important for where you're going. We're going to do fast questions as we close out. Hot seat style, Grant. So this is going to be centered around the future of self-funded search. So self-funded search has gotten much more popular. Are we early? Is this already becoming crowded? Where are we? Where do you think?
I think that the biggest gate mechanism into self-funded search is credit availability. Self-funded search exists in the United States primarily because of the SBA program. The SBA program is tightening its underwriting considerations, which I believe is a very good thing for the ecosystem and for especially the most capable and qualified searchers. Do I think we're still in the early innings ultimately of self-funded search? Yes, I do. But do I think that could I see a world easily where there are fewer but better self-funded searchers? Yes. I can. I think there are many people doing self-funded search primarily as an interesting educational experience where they just find it fun to learn about, but they're never going to buy a business, and that's okay. Like, they don't matter to the ecosystem at all, in the sense of, like, they'd never close deals, so it doesn't change the ecosystem. But I could see a world where if credit is tighter, there's less of a pitch to sell to the general public about, like, why this is such a wonderful thing for anyone, even people that have no liquidity. And I think that is potentially healthy.
Yeah. And then there are definitely more buyers entering the market. Do you feel like that will compress returns?
I think that it's predicated on the underwriting, because it's interesting talking to sellers who have deals that are SBA backable. They will get 30 proposals from self-funded searchers who all say, I would like to buy your business. I will use other people's money in the form of an SBA loan for most of it, and I will use other people's money in the form of investor capital for a meaningful portion of the other part of it. And anyone can say that, as it turns out. Anyone can say, I will buy your business using other people's money. And I think that there will be a thinning of that dynamic where people will realize that that pitch doesn't work. You have to have either meaningful personal capital yourself or really good industry experience or something. And I think that that will be a positive ultimately.
Are searchers overpaying today?
I think that the searchers definitely are overpaying for businesses. And I think that it's wild how diverse and fragmented the world is. We did a LinkedIn post recently on every deal that we've seen, the last 200 deals that we've seen, and what the EBITDA was and what the multiple was. And I think that it is wildly heterogeneous. So there are plenty of searchers that are massively overpaying. I think there are plenty of searchers that are getting incredible deals. And it's the only asset class that this is the argument in the post, is that it's not governed by the efficient market hypothesis, which I also have questions about in general. But no other asset class is like seller is getting divorced and just really needs to sell, like a core part of the market. Public companies, you know, don't have those types of issues to
They're
the
not
same
at the
degree.
whims of the personal discretions of the owners and founders. Yes.
Right.
I have two questions then. So one is about the market, and the last one's going to be about you. So what will separate the next generation of great searchers, people you will back, from the tourists, the people who are occupying the space now?
You can tell within like 15 seconds if someone is a great searcher or a tourist. A great searcher has personal liquidity to put cash in at close and to maintain post-close liquidity after close. They have a relevant track record and experience, either in something related to the business that they're buying or even in the industry itself, but at least related and transferable skills. And they just have a seriousness about them that is not based on like taking a course and being like, oh, I'm going to buy a business. Like, I'm really excited about this. It is I have, I have operated a small business, or I've been in charge of a division or department, or it's the type of person that you would potentially hire to run a division or even a whole business that you own. Many searchers, you would never hire them to run a business that you own. And a seller is thinking about it the exact same way. They're not going to sell to them. And I love the vast majority of searchers we talk to are actually excellent. So the sort of tourist searcher that I'm describing, like I don't even see them hardly because
Yeah.
they're
You're
not talking
referring,
to investors.
you're not talking about searchers, you're talking about business buyers.
Indeed.
And that's the differentiator in regards to the title. Searchers come from an institutional influence. Business buyers come from a course and content and book audience. Last question. It's the most intimate, most personal way to end this. Grant, you started saying you were to debt, and now you back leverage buyouts.
I'm averse to personally guaranteed debt of myself. I'm not averse to, I believe in the immortal words of Warren Buffett that you only know who's swimming naked when the tide goes out, and any number of positive numbers multiplied by each other with only one zero is a zero. So I'm not willing to take debt that could be game ending to myself or to multiple businesses. I'm okay in a single business where it's beautifully cordoned off and doesn't have any spillover effects. But yeah, no systematic risk. Systemic.
Yeah, because I find it interesting. It's one of the biggest concerns I have about the SBA program, although I like it as a friendly debt mechanism for the transition of businesses. It's also putting a lot of leverage on businesses that typically don't have leverage.
Correct. Yeah, which excludes the vast majority of businesses that we see searchers buying. Is it's like this is a business that should not have leverage on it,
Yeah.
so we can't invest in it for those reasons.
Yeah, it's an important distinction. Grant, any final word, whether it be about a fund, about investing in a searcher's deal to cap this episode with?
If you find yourself buying a business, put more cash on the balance sheet at close than you think is necessary. You will thank me later. It will be very helpful.
And if I want to reach out to Entrepreneurial Capital and potentially get your support either in education, mentorship, or through a deal that I have, what's the best way to do that?
LinkedIn, Grant Hensel on LinkedIn, Hensel, and then just entrepreneurialcapital.com are both great ways to reach out.
I will say this, money is readily available if you bring a deal, but who gives you that money matters. And so I heavily endorse Grant and Entrepreneurial Capital. They're just the right kind of people to support this type of community. Founders who understand founder-led businesses. Grant, I appreciate you.
Thanks, Peter. Great to be here.
If you like this episode, probably like one of our other episodes. Click here.